Hi everyone, welcome back to another episode of the Accounting and Tax Helpers. I'm Nima, and today we're going to talk about what you need to do about the tax planning when your business grows. Your tax strategy needs to evolve when your business grows because your income, your expenses, your deductions, and the risks are changing with your growth. So the problems that you have and the solutions you have for when you have a business with 50,000 revenue would be very different and maybe cost you when your business grow to 500,000. So you need to plan for all the growth, your tax planning and tax strategies, your accounting grows as you grow. So when you have a startup, the main part of your profit and loss is basically expenses. The startup costs, your home office expenses, legal fees, license fees, anything's more expenses. So you don't have a revenue yet. So there would be no tax planning needed because all you get is expenses and write-offs. So you're not paying taxes. You still need to keep track of your expenses. You need to make sure you don't lose anything, but there is no much tax planning needs. But when your business is established, you have different areas you need to be worried about: the payroll, depreciation, retirements. So startup usually much easier regarding tax, but established business you need to take care of a lot of things and make sure you're in compliance and not missing any opportunities for tax saving. If you're making just 50,000, just keep it simple. You just have an LLC for protection, and you just make sure maximizing your deductions. Your sole proprietor or LLC would be an option. When you're making 150,000, you should start considering having an S corporation and tracking the payroll. You have a payroll distribution. When you are making 300,000, you need to look at the retirement accounts, French benefits, and start making sure you take care of the quarterly estimate payments, having a quarterly meeting, tax planning meetings, and you making over 500,000. You need to have a tax strategy, solid tax strategies for the whole year. You need to make sure you pick the right accounting method, cash or accrual, that we had a separate episode speaking about cash and accrual, and then depreciation and multi-entity structure. And then need to make sure you're in compliance with the sales tax, payroll in different states. So your business grows, and you need to take care of a lot of different things that you're not dealing when you're just making 50,000. So if you're the sole owner, start making more than 100,000, that's the time that considering S corporation can save you a lot in the self-employment tax. Because when you're self-employed, your LLC, all of your income is subject to self-employment tax. When by starting making money, considering having S corporation to start saving up some of those self-employment tax. Some common mistakes that the growing business make is still keeping their company as an LLC or just the sole owner, sole proprietor, not having a tax strategy, not making any tax payments during the year. They're surprising. They don't know about how much they're going to owe taxes, and they're going to be surprised in April of the next year. Not tracking their business and personal expense correctly. Sometimes they just pay personal expenses from the business and they deduct it, and sometimes they pay business expenses from their personal account and they forgot to deduct it. They don't track of their vehicle mileage. They don't track the startup costs like legal fees or home office expenses. At what point is a good strategy to switch from LLC to S corporation? It's LLC first gives you a legal protection, so it's recommended as soon as you start your journey, start with the LLC, and then you have options to switch to a S corporation when your business grows. But in the prior episodes, I went and I talked about details, information about the LLC, C corporation, S corporation. It's please go back to that episode. There is a detailed information what areas would be an LLC is beneficial and when an S corporation or C corporation is beneficial. As your team grows, you need to make sure you be in compliance about your payroll. You need to make sure that you consider employees and contractors correctly. Again, we have another episodes details about who is employees, who is the contractors, because if you don't categorize them correctly, it might cost you. So you need to make sure people who are employees are they are in payroll. You register with payroll. If they're working in the different states, they are registered with different states. You need to have a good payroll company to make sure everything is in compliance. Tax benefits, French benefits. It's as your business grows, there are some requirements. It's not optional anymore. You need to be in compliance about your insurance and retirement account. And if you're missing those deadlines or compliance, it may cost you a lot. Let's say your business start hitting the six figure, and then you need to have a solid tax planning. At that time, you need to have a solid tax planning during the year, not after the year end. And we always talk about the proactive strategies other than reactive. If you have a children, hire your children. As corporation is always an option to save taxes, and then how much you need to allocate to your payroll, how much you should take the money as a distribution. That's gonna change a lot. And then at the same time, you need to be in compliance. The car write-offs, insurance write-offs, business travel, meal expenses, all of these needs to be, you need to take advantage of those deductions. At the same time, you need to be in compliance because IRS looking for those expenses. This is the number one area that the IRS go after, travel, meals, expenses. And then the main other things are like a retirement account. If you start going to the six-figure retirement account, can save you a lot of money, can make your employees happy. They can put money aside for yourself. At the same time, it can give you big tax savings. There is a couple of examples that the clients starting thinking about the planning that was pretty late. It's not never late, but you could have started like being more proactive starting earlier. First, they missed a lot of opportunities to start with the S corporation in earlier years, so they paid a lot of self-employment tax. They spend a lot of money on the penalties for not paying estimated taxes on time, and not weren't surprised. A lot of times they had cash flow problems for the paying taxes because they didn't plan during the year, and when the April 15 comes, they got surprised and they didn't have cash. They missed a lot of opportunities to write off their big assets. They never recorded big assets, but maybe they found that differently. And in those things are adds up, and then if you add up those things, might cost you a lot. So what signs should a business owner look when they're looking at the tax planning? The first thing they want to look if the income is, they expect the income to increase significantly or fluctuate significantly. They need to be ready. They need to be plan ahead before when they expect the income increase significantly. When they use a lot of outside services as a contractor, that some of those needs to be actually considered as employees. When you don't have a proper retirement account set up for your company. When you see a lot of tax notices, tax bills, you receive a lot of notices from the sales tax and payroll compliances. So all of those things is indication that your setup is not correct, and your growth is not related to your tax planning and your foundation. Always you need to communicate with your CPA during the year. Always communicate any changes, significant changes, any concerns you have about your business. Don't wait after the year ends and speak about your situation. Sometimes if you expect big sales, your CPA wouldn't know because your CPA are aware of things when it happens, when they see the invoice, when they see the cash hit the bank. So if they're not aware of it, they cannot plan the things ahead. They can't warn you about the tax implication of those significant changes. So always have a consistent communication with your CPA during the year. Any significant changes, any significant growth, communicate with your CPA ahead of the time and be more proactive. If you're feeling that your tax planning is outdated, first, please call a CPA or just please give us a call or send us the email at helpdesk@alamircpas.com. When you think about your tax strategy is not right or something, you're missing something, always consult with another CPA, because if you feel something is not right, most likely there is a problem. It means you're don't have enough communication with your CPAs, or your current CPA or accountant doesn't communicate with you effectively. That's why you feel like there is something is wrong. If they always give you advice and then they're in contact with you and then they warn you, you wouldn't feel like, okay, you need to have a CPA, another CPA. When you get to the point that you're worried about the tax planning, you hear things from the other people tax planning and you're feeling that you're missing some things, it's better to consult with another CPA and get their professional perspective. Thanks for listening to this episode. We talk about the good news when your business grows, what you need to do as your business grows. You need to think about growing your tax planning, your accounting, and then thanks for listening to this podcast. Please like, subscribe, leaving a 5-star review, and I will see you in the next episode.